avoid going negative or avoid going upside down. Interesting point coming from the attorney broker who started Upside Down Real Estate.com in 2008 and started helping people before then, and who had lost 4 properties in a down market in Florida and had to bring $70,000 to the table to get out of his last property because there are no anti-deficiency laws in Florida. At least there were not at the time. So I'm going to reflect. Phil, who I work with, we were doing a video and he alluded to this, like all those people who came in the beginning, and I'm going to go over those types of people. There were plenty of mortgage brokers who understood they had protections but wanted help and hired me to help them do their short sales to get out of their property, or their walkaway plans, or their short payoffs. 80% of the first 20 clients were people who knew the rules internally. Some of them were very opportunistic. They're like, I knew I got extended. I did the work. I want you to help me get out. But others, and these are the others, some of them were mortgage people, and they tried to do the right thing. They kept 3 or 4 homes. They went into their retirement trying to save things. They did not want to go upside down. And then in the end, they did anyway. They got smoked, and they were crying and they were sad. And luckily we said, well, they can't go after you anymore. They realized, you mean I could have stopped paying a year ago? And I go, yes, because none of these properties, because you only have one loan. They either had only one loan. And so after a non-judicial foreclosure, the bank wouldn't have to see a deficiency. Again, everything I'm saying is for education. Every situation has to be examined by someone before you trust the advice. But I'm saying that she had multiple properties. She would have taken a non-judicial foreclosure on all of them. I said, of course, talk to me if there's a judicial foreclosure. And I explained what that looked like. But what a deed of trust, I was like, this is going to happen. This is the timeline. Talk to me if things aren't going to happen. But I was like, you're not going to have to pay taxes on, you're not going to have to pay the bank on the deficiencies. We'll have to look at your loans to see if you're going to have any tax exposure, whatever they were. But she began her workout, began her life that day. And I'm sure she survived. She was young. She just poured all her savings into these loans. Now, the next round of people, this was a little different. There were people who are like, I could have gotten out early. I knew it was a problem, but I had taxes and I didn't want to deal with the capital gains. And I was just hoping, but I should have gotten out. I just didn't want, I knew I only had 500,000 capital gains, and I knew I was going to have to pay taxes on the other 600. For those people, and this just came up for me during the week, your advisors are, well, first of all, a realtor's not even capable of talking to you about this. But there are, like if you're willing to turn your property into a rental property, there are fantastic ways to deal with the gains. You can get double dip on this. You can get a $500,000 exclusion, and then by turning the property into a rental for 2 years, you can then eventually deal with the capital gains on the rest and either defer or actually, I mean, you'd have to work it out. But the point is, you might much rather put that money into a new rental property than just give 200 and maybe on 600,000, maybe pay more than $200,000 in taxes on it, because you're going to look at the IRS for capital gains. You're going to look at the franchise tax board, maybe for another 9 to 10%. And then there's also like an NIT. There's a small, extra federal tax on big capital gains that you might have to pay. So, you could conceivably see a third of your capital gains go away for taxes. And maybe you want to use that $200,000 to get a property that could provide more income. So it's like, don't just not do the move because of taxes. I mean, if you're thinking it's time to sell, now might be the great time to do it, because you'll still have 90 days to locate property, and maybe you'll locate that property in a state that's already gone down. Personally, having been a lawyer and a realtor in Florida, where I lost my properties, I can tell you, I still think I would stay away from Florida, because they have all sorts of issues, not just investors backing out, not just, we're going to do further things. We'll talk about Florida separately. But there might be good places for you to invest. Maybe it's just smarter to invest in a lower price property to begin with. That's another insight. For those who are wondering how the market reacted last time, it reacted very much like an accordion. I remember at the very end, things started changing, but it was like, here's the prices now. And then they collapsed almost like an inverse, how much the margins between the properties just collapsed. And the lower end of the market stayed a little stronger normally. I mean, sure, there were probably some areas where it collapsed, but in general, you could say the first-time home buyer properties and the properties maybe only a little bit above, they took less percentage drops than the big properties. So you can expect an accordion to be going on. And I think that accordion could be happening right now, because just on Friday, you know, we're starting to see like we had this huge gold and silver, like people, it was running up like there were real problems. And then Friday was an engineered collapse of the silver market and others. And this is what happens when investment banks get in trouble. That, you know, they're tied in tight with the Federal Reserve. And when those banks could blow up or the system could fall apart, all of a sudden they do things like, after exchanges close or after the European markets are closed, or the Japanese markets, they'll do something in their market to collapse and let the bank cover their shorts. And it seems to me that that was an engineered market. You're going to see in these markets with unstable things going on, you're going to see some really odd things happening. As I can recall, similar things happening back in the short sale days. There'll be like bank bailouts. And I don't even know why I brought that up, but I was like, you probably want to be ready to take advantage of those opportunities. Like towards the end of that short sale market, people started buying up properties really, really, really inexpensively in certain areas that had collapsed, like Arizona. Phil was just telling me today. I mean, there were properties that were going for $40,000 to $90,000. So you want to build up your assets, get your powder dry. And that's another thing. Let's say you're already upside down. Well, you might want to, California's real estate has not, I'm sorry, I lost my train of thought. If you're already upside down, rather than do a short sale in the beginning of the market, you might want to start off with a deed in lieu. You might want to if you're going to take a credit hit, you might want to stay in the property if you leverage California law as well, you might want to stay in the property for a year and build up your cash. So really, I guess what I'm saying is that exits in a market that's softening should be thought about, and they should be sequenced. And so we're putting this video series together at UpsideDownRealEstate.com, where we're going to talk about what someone with equity should be doing, what someone with who's slightly underwater should be doing. So if you have more than an upside down property, so your house is worth more than you owe in the loans, but maybe less than what you'd have to pay to sell it with traditional realtor fees. So on $1 million property, let's say your property is worth $1.05 million, but realtor fees are going to be 5 or 6%, and you need another 1 or 2% to close. Well, where are you going to get that $20,000 to $30,000 from? Well, you don't want to go under. You don't want to say, okay, let's do a sale. Let me lock into this contract with the realtor and be short and have to turn into a short sale. You want to be in an agreement with your realtors where you can cancel at any time if you don't like the numbers, or that where an equity peel down agreement where your listing realtor agrees to reduce their commissions to make sure you don't go negative. You want to work with a realtor who's capable of doing that with the buyer agent commissions if necessary. So there's a lot of strategy that goes into selling a home in a soft market that you didn't have to use in an up market. And we'll be talking about that in this video series at UpsideDownRealEstate.com. Thank you.